Is it safe to bet against either of these asset classes? I call Cathie Wood an asset class, but you got to admit, John made this point earlier, it's hard to find active managers that really make big bets. You can get kind of like passive active managers, but Cathie Woods makes big bets, and she blew up on the upside and she blew up on the downside. Let's just handicap China and Cathie Wood.
Yeah, well, first of all, Cathie Wood just didn't blow up on the upside last year. She's been at it for a while and has put up really, really good numbers. Her team has a long-term outlook. They haven't hidden the fact that their outlook is 5 to 7 years. And although many people came in the last 18 months, it's okay because, look, even though many folks are retiring in their 60s, they're going to live well into their 80s. I've talked about Cathie Wood and her lineup to younger people all the time. But listen, Bob, I'm going to be 62 this week, and I'm invested in Cathie Wood and will continue to be for the next 20 years because I know the future FANG stocks are going to come up in ARK portfolios. So you just have to ride it out, and if you're diversified, you're probably doing okay. Quickly on China, China's not going away. China's going to continue to be a big part of the global infrastructure, and we are clearly intermingling with China on a daily basis. I think China's a buying opportunity. There are a lot of companies like Crane Shares who do a great job. When you intermingle China and online buying, it's something that we're going to be talking about for the next 10 years.
First, happy birthday, Tom. Always a pleasure to be with you. You're a few years younger than me, and you look terrific. So you got a lot. You got a lot more time and a lot more time for you and I to interact together over the years. John, your comments on Cathie Wood and China. My thought on Cathie Wood is a lot of people say, she failed. I don't think Cathie Wood failed. I agree with Tom. I think Cathie Wood succeeded in convincing everybody about the powers of disruptive technology. The problem is everybody believed her. They bought in and drove the prices up to crazy levels. And at some point, somebody's going to start asking about valuation questions, particularly around certain companies that don't make any money or companies, that are flattish for the next few years in terms of earnings. It will matter, and that's what's happened. The people have started saying, we don't hate these stocks, we just want to know what the right price is given the environment we're moving into in 2022. So give us your take on Cathie Wood and China.
No, I agree with a lot of what you guys said. I mean, at the end of the day, if you're trying to find the next FANG stocks, I mean, she's probably the most qualified out there. So look, I mean, she had 4 or 5 great years, 1 bad year, so I think that's okay. I think the market environment has kind of changed in terms of people are now starting to look at earnings and profitability a little bit more. I mean, at the end of the day, this is now the 3rd year of the COVID recovery, so we are now late cycle. Interest rates are rising, so I think that impacts, the future discounted cash flows for a lot of tech companies, and a lot of the ones that I think in our portfolio, they're not really profitable. But I think she's the best to kind of look at the next FANG stock. So, I've always said when it comes to, disruptive growth, Bitcoin, you got to size it appropriately in your portfolio. So it's got to be less than 5%. If it's less than 5%, then you can ride out these waves. For China, look, I've been on your show, Bob, many times talking about China. We liked it. We were overweight. It was a very difficult year last year for China. I don't think the billion people out there, I still think there's a way to monetize it. And, we've always told investors it's a long-term play. So again, we size it appropriately in our portfolio. So I think you got to stick with China in your portfolio as well.
I think the problem I have, my 2 cents on China, is there's 2 kinds of investors in China. One are the value guys who are floating around saying, all right, if it's 15 times forward earnings or less, we're interested, and we don't care about the politics. Historically, it's performed well when you get 15 times forward or below. And there's a sort of, a knee-jerk kind of investment ideology or strategy, a value strategy. I think the broader problem is with the people who are in the global community who are trying to figure out, used to believe that you could have China as an investable play based on, say, market capitalization. And what's happened in the last year is people are now saying, wait a minute, the political risk factor around China is far, far higher than in other countries around the world. Therefore, do we need to completely relook the way we're investing in China because of the higher political risk factor, or is it even, should we even consider investing in it given the particular ideology involved in the country? So there's an overlay here on China that didn't really even exist a year ago, and that's one of the things that I'm having trouble dealing with. Should we say, yes, we need to be compensated for the higher political risk component associated with it, or could you go even further and say, no, China's uninvestable at this point? Tom, do you get my point here? How this debate's changed in the last year?
You're right, Bob. But the key thing is China continues to grow. Their investable assets continue to grow, and with that, there's more demand from a global market cap standpoint. But to John's point, you have to allocate an appropriate amount. Listen. The U.S. and the rest of the world and China are always going to do saber rattling, and it's going to be part of the landscape going forward. So we have to know that. Does that mean you avoid it 100%? No. They're not going to shoot themselves in the foot. There's always going to be the back and forth, the ebb and flow, and that's something that's consistent with China over time. So you just have to factor that in and then have the appropriate allocation. If it has a run-up, pull back, give it that 5 or 10% allocation in equity portfolios that's appropriate. But, if you do overweight, you're going to live and die by the sword.
Yeah, it's a good point. All right, gentlemen, I'm going to have to leave it there.